Hey, what's up everyone, and welcome to the School of Personal Finance. So this stock market has been crazy. Some of these stay-at-home technology companies, it has reminded me a lot of the dot-com bubble back in the late 90s. And that just so happens to be when I personally put together my first stock portfolio. So in this video, I'm going to share with you the story of what it was like investing back then, the wild ride that I encountered, and all of the lifelong valuable lessons that I took away from that experience. Let's get to it. If you're new here and you like learning about money, go ahead and hit that subscribe button along with the notification bell. I post videos each Friday all about helping you become great with money. The year was 1997. I was a freshman in college. Computers, the internet, it was all just starting out. It was in its infancy. Cell phones, nobody had cell phones, and whoever did, they only used it to make phone calls. There were no smartphones, there were no iPhones. During that time, I had a relative who passed away and left me $10,000. And I remember my father coming to me and saying, you should invest that money in the stock market. Now, I was really just starting to learn about the stock market. I had a big interest in it, but by no means did I know what I was doing or really understand how to invest. So with his help, I don't know if he really knew what he was doing either, but with his help, we sat down and we picked out 5 stocks to invest in. The 5 stocks that I invested that $10,000 in were Dell, Microsoft, Cisco Systems, AOL, and Intel. And looking back on it, those were some pretty damn good stocks to pick at that time. So as you could imagine, I went for a wild ride after that. This is like in early 1997. So I invested that $10,000 and the market just took off. And it wasn't just the market, those stocks took off. The NASDAQ took off. Technology, the internet, the boom was on. And I sat there and watched as this portfolio went from 10,000 to 20,000 to 40,000 to 60,000. And before I knew it, in March of 2000, a few months before I was going to graduate college, that portfolio was up over $90,000. And I was on top of the world. I used to sit there with my calculator trying to calculate how long will it take before this portfolio reaches $1 million. I was using a growth rate of like 25% per year. I was very naive at the time. The NASDAQ had just hit a fresh high over 5,000 for the first time, and people were partying in the streets. It was like these no-name companies just taking off as long as they had a .com at the end of their company name. It was insanity. And then as I got closer to graduation, the market started to cool off a little bit. So I believe it was May of 2000, the month that I graduated, we had a pullback in the market. But the only thing that I had known up until that point was that pullbacks were an opportunity to buy. The market really only went up ever since I started investing. But that was not the case. So as the months went on, we started going lower and lower. And I didn't even worry about it. I didn't even really think about it. I just figured that it would just bounce back. I was actually looking to invest more money on these pullbacks because that's what everybody always said to do. But as time went on, I sat there and watched as this $90,000 stock portfolio went all the way back down to about $20,000. Let me show you a chart real quick of Cisco from when I bought it back in 1997 up until the peak in March of 2000. This chart looks a lot like some stocks right now, like Tesla, even Amazon. I mean, this thing is to the moon. Now let me go ahead and expand it a little bit and show you what happened after the peak and where it went the next few years. Now, I'm not saying that these high-flying tech companies right now are going to follow suit for what happened back in the dot-com bubble, but it should make you stop and at least give it a little bit of thought. Over the course of a few years, I still doubled my money, but it was a painful double. I regretted not taking some profits as these stocks were going up or not knowing to sell when they were at such insane levels. So after licking my wounds and facing reality, I just went on with my life. And I graduated college and I started working and I started contributing to retirement plans. I didn't let this, allow me to just totally be put off by stocks. I did continue to invest for my future. I still believed in stocks, but it definitely put a little bit of a sour taste in my mouth. So I ended up selling out of all of these stocks by 2003, which was the year that I got married. So 3 years after the height of it and after I graduated college, and we used that money as part of a down payment when we bought our first condo. So unfortunately, I wasn't using that money to buy a high rise in downtown Manhattan or to buy a new Ferrari. But the truth is, if I would have held on to that portfolio for the next 20 years up until today, I would be doing pretty good with it. So now let me go ahead and share with you the valuable lessons that I learned during this period. And they're lessons that will stand the test of time. Like, you should come back and do a refresher on this every so often, just to remember, because it will help you become such a better investor and understand the stock market better as well. All right, so the first one is a term that you hear thrown around all the time, but in my opinion, it doesn't relate to anything better than the stock market, and that is hindsight is 20/20. It is so easy to go back and look at a chart and just to say, it was so obvious back then, how did you not do that? And honestly, this is what makes managing money for people so difficult. This is the hardest part, is that you have people who don't really understand how the market works, and they sit there and they say, well, how did you not know that that was gonna happen? Isn't that what I pay you for? Why don't I own Tesla right now? Right? People look at the past and believe that they would have known what was gonna happen, but it's just not the way that it works. So I challenge you to every single day say, what would I do today? Where do I think things are going today? Because it is a very hard game to play. Even as I sit here at the end of July, where is the market going from here? Are we going much higher, or are we gonna go back and retest the lows? Where is it going? Nothing seems to make sense these days, so nobody knows. But once it's over, when we're in January of next year, I could easily tell you where the market was gonna go today. And don't get caught up in the would've, could've, should've game. You'll drive yourself absolutely insane. I should have bought houses in Las Vegas in 2009. I should have bought more gold a few years ago. I should have bought Tesla stock. I should have bought Amazon stock. Who would have known? I should have dated more girls before I got married. I'm just sneaking that one in there to make sure that my wife actually watches, because she says she does, but I'm not really sure if she does. And now the second thing is that stocks don't always just go up. It is not always smart to buy the dips. It has been that way for the last 10 years or so. So if you just started investing 5 years ago or 7 years ago, all you really know is up. You haven't experienced any pain yet, but the pain comes. And when it does, it comes in long periods and it hurts. And it makes you not want to invest anymore. Young investors have not experienced that yet. And that worries me, because every dip, all you hear is buy the dip, and we're going right back up. And that's the way that it's worked out, but it doesn't always work out that way. Hey, I'd love to see a ton of comments on this video. If you could do me a solid and just in the comments, write the year that you started investing. Even if it was in your 401k or your IRA, just the first time that you ever invested in the stock market, just write the year in there. And you could throw me any kind of little note that you'd like to say as well. Thanks. Number 3, stocks could run in either direction much longer and farther than you think seems normal. And I've learned this many times throughout the years, where if you take profit in something because it's had a good run, you might be cutting it short. Like if I would have done that with Cisco back in the day, if I would have sold it at 30 because I tripled my money, then I would have missed out all the way up until 80. Like, yes, it did go all the way back down, but you get the point. Sometimes these markets seem completely irrational and it goes on for a long period of time. The truth is, nobody knows what is going to make a change and when it is going to change. There are times when potential and momentum completely outweigh valuation. Look at Tesla. The valuation is insane, but that's not why people are buying it. People are buying it because of the momentum and because of the potential that it could absolutely change the world. So things may not make sense to you or me, but the market doesn't care. Number 4, don't trust anyone's opinion, including mine. Nobody knows. Everybody has a 50-50 chance of being right. If I say the stock market's gonna go higher, I'm willing to place that bet because it's 50-50. If I'm wrong, I'm wrong. If you watch CNBC, you could have a room full of the 10 smartest people in the universe, and they all have a different opinion. So I'm not saying don't trust them because they're shady or trying to steal your money. I'm saying don't trust them because nobody knows. No matter how smart they sound, how brilliant of an investor they are, nobody really knows. So real investors who have a long-term track record, they're good at placing bets where the probabilities are in their favor. They're good at balancing risk versus reward. The reason that people should be hiring money managers or financial advisors is because they understand how investing works and they understand how the markets work, not because they can predict where the market is going. This is a big misconception. I have clients or people that I've spoken to who assume that I know better than them what direction the market is heading, and that is not true. Nobody knows what direction the market is heading. Yes, we could all make educated guesses and we could run our analysis and say, because of the charts or the fundamentals, this is where the market's going. But the truth is, nobody knows. So anybody who is so certain and selling you on the fact that they know what's going to happen next, those are the people that you should really run from. And then my fifth lesson is that over the long term, markets have always gone higher. So if we look at a long-term chart of the S&P 500, the trend has been up over the long term. So the best way to invest is to what's called dollar cost average, to make constant contributions, like with a 401k where you're contributing every 2 weeks. It's those investors that try to pick the bottom or sell at the top. Those are the ones who end up being left behind, who end up feeling like the market is rigged. It's those investors who sold back in March of 2009 that felt like the market got the best of them. Or it's those that bought the NASDAQ back in March of 2000. They went a while before they even broke even. So it's hard to pick the right time to invest. The best way to do it is to just invest throughout your entire life, because odds are you're going to be buying at lower prices, the market's going to go up, and you will make money over the long run. For long-term investors, the market going down is a good thing because it allows us to buy more at lower prices so that eventually when they go back up, you're holding more shares. You don't want the market to go straight up. You want to have periods of time where the market is flat or down, where you're continuing to put money in so that when the move higher goes, you have more and more stock and you're making more and more money. As you can see, almost 20 years later, I still love the stock market. I love investing in it. I love talking about it. I've had my ups and downs with the market, but overall, I am a fan of investing in the stock market. And I've come to the conclusion that the best way for me and for what I think is most people out there is to invest in passive index funds for the majority of their money. Now, I do also invest in individual stocks, and I do encourage other people to do the same. Just have that be the fun money, the stocks that you use their products, that you enjoy, that you like to follow, that you're rooting for. I do think that it's fun to do that as well. All right, everybody, that is it for this one. I hope that you found that helpful. Please make sure to hit that subscribe button if you've not hit it already. Hit that like button, make it light up and turn blue. I will see you again next Friday in my next video. Also, follow me on Instagram. I'm posting, a couple times a week, throwing some pictures up there. I'm throwing some up this week of my recent family vacation. So make sure to follow me over on Instagram. I'll see you guys next Friday. Thanks a lot.